Well, we know with the cocktails and mocktails on the screen, we are in the home stretch. Not there quite yet, but those were filmed in the courtyard of the Taj Hotel. You never know, we may be retiring there relatively soon. So, before we do, however, I want to get to an interesting and important discussion. Prime Minister Modi's ambition for building an Atmanirbhar Bharat rests heavily on the availability of homegrown capital. So let's look now at the key areas where India can draw on to build the strong domestic capital base. To discuss this further, please do welcome to the virtual stage the Principal Economic Advisor for the Government of India, Sanjeev Sanyal. Welcome. Thanks for joining us and staying with us on stage here in London, Chairman of KKR India, Sanjay Nayar. So to begin, I'm going to pass the floor over to Sanjeev for some opening remarks.
So I think, as I stated yesterday, the Atmanirbhar Bharat idea is not a return to some autarkic pre-1991 isolationist worldview. It's about leveraging Indian strengths for resilience and growth, and to participate in global supply chains and the world economy. So, while of course we do want to leverage Indian capital, no doubt about it, and we need to deepen Indian capital markets. We need to get our banking system out there and lending more aggressively. But I wouldn't argue that it is based on merely getting Indian capital. I mean, we are clearly open to global capital, FDI, and foreign investment are at peak levels, in fact, in the last 1 year, despite the COVID shock. So I think the main thing that we would like to say is we are, of course, interested in a vibrant Indian capital market. We do want Indian savings to be driving a lot of this. We want Indian risk-taking, innovation, animal spirits. But this is not a vision of some sort of an autarkic economy which is only reliant on Indian capital. I mean, we are, as I said, very much a part of the global economy and will continue to be so.
Thank you. And we do know that you are open to FDI. In fact, the next panel will look at that FDI question. So thank you for those opening thoughts. So let's turn, Sanjay, to you. What opening thoughts, what reactions do you have to Sanjeev?
Well, glad to be here. Hi, Sanjeev. Look, I think all the points Sanjeev made were absolutely valid. We are an open economy. In fact, we represent foreign capital. The kind of capital folks like us bring in and our peers is foreign savings, pensions, insurance, people's savings. So that's, well said. And I think we have seen peak fundraising last year in India, about $60 billion in the first 6 months. And this year already you've seen probably a 33% uptick over the previous year on year. So this is during COVID-1 and COVID-2. So obviously India is a favored destination, a lot of opportunities for growth, and hence a lot of foreign capital flowing in. And I'm just referring to the private side, not the public markets. My view is that today India needs, frankly, more of a supply shock. You need the private enterprise in India to step up, the private sector to step in. The government is doing a lot, as we know, in terms of spending what they can, given the fiscal space they have on infrastructure spend, now on healthcare, and these indirect schemes to support microfinance and micro institutions, which I think is a very smart idea without too much of cash outgo. But then when you think about building the Indian economy with private sector jumping in, not everybody has access to foreign capital, number one. There need to be more institutions that can take the risk capital put risk capital to work, whether it's debt or equity. There are very few of those today for smaller companies. I think that's one contention I have. The second point is that, capital markets in India on the equity side are extremely deep and robust, very wide. But when you go down to the debt markets, you do see there is a fairly high degree of narrowness of what really trades in the markets and how you price risk versus the reward. So if you look at some of the building blocks around this world over, a bankruptcy code has been a fantastic start. You need that. Without that, you can't price risk. I think that's a great start. It probably gets more embedded as you go along. You've got the banking system that is, I think, getting there, and there's a lot of cleanup going on, and the creation of the asset management company, the ARC at the national level. These are all great announcements. If you look at the creation of new instruments that the government has really propagated and propelled, like the InvITs, the REITs, the IDFs, these are all, again, great ideas. And I think as these come into play, my real view is that you got to really now get the local savings unlocked, which I think are quite a lot in the pension and the insurance companies, both public and private, and bring them into these real markets, especially on the debt side. I'll just give you an example. I mean, since the REITs and InvITs were created a couple of years ago, 200,000 crores, so that's 2 lakh crores of assets have been created. And most of them backed by foreign capital. And I think the participation in the secondary market is very, very welcome through local capital. So a lot more of local participation, alignment of pension, insurance, capital market rules, all of them anyway come into the Ministry of Finance, streamlining those regulations, unlocking those savings, bringing long duration capital into the local markets. I think really gets especially those asset classes going that are very long duration, like real estate and infrastructure. And those are building blocks, frankly. So I don't disagree at all with what Sanjeev said. I just think this is a great time to build that vaccination against a future taper tantrum or whatever by creating larger local bases of capital in key sectors of the capital market, especially new asset creation, so that we are not, hit by fluctuations globally. That's the only point I'm trying to make.
Thank you. So let's go back to you, Sanjeev, and talk about what some of the changes that you see will be necessary to unlocking some of this domestic capital.
Well, I think what we have in India as far as domestic capital is concerned is a bit of a disbalance. We have equity markets at all-time highs. You just heard that we are raising reasonable amounts of money from the private capital side. But on the other hand, there is another source of capital that has not really been firing all cylinders, which is the banking system. Now, there are many long-term reasons, including a lending boom that happened earlier in the last decade, that have led to misallocations of capital, and a lot of cleaning up of that happened over the last few years. And as a result of which, the banking system was for a while not entirely well capitalized. We spent a lot of time capitalizing it and so on. Of course, there's been one good result of that is that we went into this crisis very underleveraged. In the sense, the banking system hadn't been lending for some years when we entered this crisis. So since we were quite underleveraged, ironically, the banking system probably survived this crisis better than it would otherwise have been, because only the very best balance sheets were borrowing for the last few years. So I think the fear that the Indian banking system, NBFC sector, will be left completely impaired and unable to emerge out of this crisis, I think that is not true. I think the banking systems, the balance sheets, although there will be some impact, of course, we won't get unscathed. The impact is going to be nowhere near what many of the pessimists think. I think the banking system and the NBFC sector came out of this crisis rather unscathed, relatively speaking, to the situation. But it does need at some point to get out there and lend again aggressively, because you cannot run on one leg. And you can have great capital markets, all-time highs, etc. But that's only going to happen if you have a banking system that will keep up with that expansion. And in this context, of course, we do need to take into account the public sector banks that.
Oh, I think he's frozen. We'll get his video back in just a moment for you. So good moment to come back to my guest on stage. So tell me, Sanjay, he was talking there about the banking sector, how the banking sector had been relatively underleveraged, so hadn't been lending. So in fact, has come out of the the pandemic perhaps better than it could have been.
No, I think it's a very valid point he was making. But remember, we had entered 2018 highly leveraged as a banking system. Post ILFS crisis, it was exposed. A lot of cleanup has happened. So you're right, we went in under leveraged, but that's good and bad because no one is lending. And I think that's the real issue. And that's the point I was making, is that ultimately it cannot just be banking capital that drives lending and growth. You need the intermediation of private sector savings, which have a different way of looking at risk reward. And you have to bring that through the markets. For example, the bond market. I mean, everywhere in the world you have municipal bonds, you have infrastructure bonds, you have project finance bonds. You don't expect the banks to be lending 11 and 17-year money. So that's where I was going with the discussion, that it's time that, well, it's a good time for India. The banks are under leveraged, they can do some lending. Hopefully we come out of COVID too pretty unscathed or with a small amount of hit. And this is the time to build whatever reforms are required to bring in long-term Indian savings into the real sector, so that you're not depending only on banks in India and only on foreign capital.
So you mentioned that real estate was one area that needed more focus on. Can you develop that a little bit?
Well, I was referring to both real estate and infrastructure. Real estate in India otherwise is a pretty opaque system. I was talking of the investment trusts that have been innovated in India, and they've been extremely successful, both the investment trusts in the infrastructure space and the real estate space. And what I was saying, that these platforms are run by professional managers. They are able to garner assets, then they're able to improve them, and they're able to distribute earnings and grow. This is the kind of stuff that retail shareholders and local stakeholders would love to have. I mean, imagine if you're sitting on an investment trust or a real estate trust generating 5-6% cash yield, a little bit of growth every year. You get 8 to 9% a year, some tax benefits. So the government has been making incremental changes, and I think those are progressing well, where you encourage retail stakeholders to come and trade more of these assets. This is a massive, massive pool. They have recently made some changes, like reducing the trading lot of these instruments. They made some changes where the mutual funds can invest in this. Now there are some changes coming up where the banks can lend to these entities. There are some things still pending on the taxation angle. When you receive these dividends, what do you do with these in terms of taxation? And also, what does it mean when you sell the instruments and have a capital gain? How are you treated? So some things are pending, some have happened, but a concerted focus on just these two areas. You can imagine the creation of new infra assets and new real estate assets, and harnessing the old ones and making them better can go a very long way in creating the supply side that I think you heard the previous panel talk about. India needs, at this time, really a supply shock, frankly. And you get that supply shock with the help of, yes, foreign capital, but also local capital, I think makes it an incredibly robust model coming out of COVID.
How much has the mutual funds industry advanced in India?
It's very large. I mean, it's come a long way. It's come a long way in the last decade. It's still about 12% of total GDP, so it's not very large compared to some markets, but it's still very, very significant. The mutual funds have come a very long way. And I think Sanjeev mentioned that earlier, that the equity markets are at all-time high, extremely deep and robust. So yes, mutual funds have come a very long way.
So we've got Sanjeev back, delighted to see. So Sanjeev, let's come back to you. How do you think India can unlock these dormant pools of capital, corporate, household savings, personal pensions, safely and efficiently?
Well, I think I had made the point a little earlier. A lot of this savings goes into our banking system. We need our banking system to step up and lend. And it will. Because as I said, the banking system is perhaps not as impaired as many people fear it would be from this crisis, because we were simply not very heavily leveraged going into this. But I think there is additional issues here. I think we need to get our insurance part of our financial system much larger than it is. We need other pools of capital, including unlocking And we have tried that before. Pools of capital, for example, gold. There have been made attempts to try and leverage that, not very successfully thus far. But what we need ultimately to do is to have a system of on and managing risk through the system. And for that, we need to have things like, for example, corporate default swap markets that need to evolve. And in this direction, we have in the last couple of years done a lot of things like, for example, introduce bilateral netting. So, the corporate default market can pick up and so on. So you need the full array of risk management tools that need to be in there so that this pool of capital can be leveraged and deployed.
What about some of the changes needed in listing regulations, takeover codes, that kind of thing that can help India become more self-reliant?
I think a lot of that has happened recently. We see our local regulator, the SEBI, making extremely progressive changes. Every board meeting, we're finding it's becoming very, very progressive. I would say those are not the big issues that are meant to be kind of tackled right now. I would just say, maybe adding to what Sanjeev was saying, it's also probably worth talking about creating more institutions like the NIIF, which is a locally incorporated and locally promoted sovereign fund in a way focused on infra and debt markets. Maybe more of those with different styles, different risk reward would also help a lot. And those can be again contributed to by Indian resources as well as foreign. And I think it's just good to have a lot more homegrown institutions who participate in creating infrastructure, real estate. Doing business in India is becoming easier. A lot more people are going to be putting up factories for supply chain replacement from China. So all of this actually, according to me, comes together very well. And as we talk about the supply shock, I think it's time to unlock more local capital to create that, to sort of multiply that shock.
Sanjeev, can I get your view on what it might take for debt capital markets to finally achieve the debt and liquidity that is attractive to issuers, to relook at their bond issuance plans in Singapore, Hong Kong, etc.?
So if you're talking about domestic market, and I hinted at that just earlier, ultimately you've got to remember corporate bond markets can only function if you have a default swap market. Simply for a very simple reason. If you don't have a CDS market, you can't get the liquidity that you need. Corporate bonds, by their very nature, globally, are illiquid instruments. So the liquidity of that market is essentially created by the CDS market. And the reason our markets were illiquid in India was the fact that we didn't allow for something called bilateral netting. But incidentally, we've created that law last year. And in the course of the last few months, we introduced every single regulation needed for a corporate default swap market. So all the pieces are there. Now it's a matter for that planned out. As far as more foreign resources into our capital markets, well, we are taking a lot of steps in terms of getting ourselves included in global bond indices. At least from the sovereign side, we have made many changes recently, and we are now in talks with global bond indices. So I'm quite confident that we will be, within the next 12 months, part of some of the global bond indices, which is, of course, a big source of money for the government directly, but it also releases domestic resources that can then do other things. And again, coming back to the point about risk-taking, it's very important that we have a system of risk, whether it comes through from institutions that Mr. Nayar was mentioning, which is relates to NIIF and the new development finance body that we are creating. This for long-term financing of large infrastructure, but also at the other end, institutions that lend, onto the retail at the very bottom of our economic pyramid. So the whole range is needed to get going, and at every step, whatever changes we need to make, we will keep making them. We have been as flexible as possible, and we will continue to do so.
Maybe I can ask him a question.
Absolutely.
Sanjeev, I can ask you a question. Maybe one of the issues of of bringing in local capital, how do you think, what's the role of the fiscal deficit? Obviously, it's a pretty large number. I know all of you are extremely focused and actually rightly quite hawkish about it. Do you think that's one reason why why bringing in local capital from sectors that normally finance your deficit is one reason why the progress on that has been slow? I mean, it's just a frank question. There's nothing wrong with it because
the point is, obviously having a very large deficit gobbles up resources. Let's not pretend that anything else. Now, obviously, during a shock like the one we've gone through in the last 1 year, we took the judgment that it is okay to expand the deficit, let the government take the risk because the private sector is not going to take the risk. But you're right. I mean, in the long run, it crowds out other kinds of investment, and we do need to be very, very careful that we don't allow the deficit to remain permanently on this level.
Absolutely.
But once growth gets going, before that, it's the government that has to, in some ways, bankroll and backstop the risk taking, whether it's in terms of actually taking the deficit or what we have done more recently is guaranteeing the private sector in various ways.
Thank you so much, Sanjeev, and thanks for battling the digital transformation monster to be with us today. Thank you to Sanjay as well for not just this panel, but the final one. We'll let you go. We'll be back in just a moment to look at the foreign capital that continues to flow into India. Stay with us.
Thank you.